Second. Okay.
All right, everybody. My name is Brian Poncelet. You probably, if you've on this seminar, you're either a client of mine or you've probably been to one of my retirement seminars. And as you know, I'm a certified financial planner and wanted to introduce you to Jim Kibble. Jim is a chartered accountant. I've actually worked with Jim personally on my situation. As many people know, that I've got two adult autistic boys that we set up trusts for, and fair bit of work actually. And one of the things is I think you're going to learn is what you think you know about wills and everything else in Ontario is maybe not what you think it should be. So without further ado, why don't we just jump in, Jim, and take her away? Oh, by the way, this thing is being recorded, and so if you want a recording, just send me an email, and I'll follow up with a recording in a day or so. All right. So go ahead,
Okay.
Jim.
Okay. Well, thank you very much, everybody. We've got half a dozen or so, maybe a few more than that, people attending tonight. And thank you, Brian, for doing the legwork to organize this event. I've done these workshops with Brian a couple of times now, and I always enjoy doing them because teaching is one of the things that I love to do. And as Brian mentioned, I am a chartered accountant. I do not sell insurance or investments or do tax returns. My company is called Ontario Estate Consulting Solutions Inc. And this is my website here. You should be able to read that on the screen, www.ontarioestateconsulting.ca. And if you need to get a hold of me after tonight, that's where you can do it. Um, so my practice is fee only estate planning. That's all I do. I've been doing it full time since 2017. And since then, I've worked on over 800 estate plans in the province of Ontario, helping people put together not just an estate plan, but a good estate plan. And what we're going to be doing tonight is quite interactive. I never do this workshop the same way twice, as Brian will know. What we're going to do is we're going to allow you to comment on the topics that you think are of interest to some of you, and you can unmute yourself and ask. But without further ado, I'm just going to share my screen quickly with you. And I'll just get that going here. So when I do a workshop, on the screen, what you are seeing is the most common things that people ask about. And some of these things relate to Canadian estate planning, and some of them relate to various aspects of US estate planning. It is not my intention to focus on the US side of things tonight. I'm going to focus on the Canadian side of things. But just so you know, if you or your family is involved in any cross border sorts of activities, there are usually interrelated estate things that happen there. But the most two important things that I always like to cover is on the Canadian list is number 4 and number 5. So why do you want to have dual wills if you are living in Ontario? Uh, I'm going to, as Brian would know, 50% of the adults in Canada do not have a will of any kind. And of the people that do have wills, many of them are wills that are out of date and are not optimal. And one of the things that makes estate planning Ontario optimal is having 2 wills per person rather than just 1 will per person. So any of you out there that has no will, if you're in that group, we want to try and motivate you tonight to getting a will of some kind. Having any kind of a will is better than having no will. But if you only have 1 will, then if you consider upgrading to getting 2 wills per person, 2 wills per spouse, that's a big upgrade that is going to pay dividends to you. So we'll talk about that first, and then we'll talk about number 5, which is choosing your estate executor. So on my mind map here, we're going to go down to the section that deals with dual wills. So I'm going to scroll down here, and I'm going to talk about probate. So in Ontario, we have an Ontario probate tax, and in Ontario, our probate fees are 1.5%. Now, every province has a separate probate protocol. Our probate fees in Ontario are the second highest of any province in Canada, second only to Nova Scotia. And for that reason, having two wills in Ontario rather than one is excellent estate planning. Every client I've got, and I've done over 800 estate plans now, every one of them has got two wills rather than one. So the reason that you want to have two wills is because in your secondary will, that is where we have estate assets that reside that are isolated, where we can exempt them from Ontario probate. And the things that qualify to go into a secondary will include any vehicles or watercraft that you might own. So if you have a motorcycle or a motorhome or a car or a Sea-Doo or a yacht or a sailboat, whatever it is, anything with a wheel or a motor or a sail can go into a secondary will, and then it does not attract 1.5% Ontario probate. I'm just letting somebody else in here. Okay. The second thing that can go into a secondary will and exempt it from probate is all the personal effects that you might have in your residence. So whether you live in a condo or an apartment or a house or a farm or whatever it is that you have stuff. And when you only have one will, it means that your executor, when you die, is going to have to inventory everything that you own from a personal effects point of view and appraise it for its value, and then pay Doug Ford and the Ontario government 1.5% of the value of those assets. That includes things like stamp collections or collectibles or jewelry or artwork or musical instruments or tools, anything like that. Not only just that, but pots and pans and clothing and knickknacks and antiques, all that kind of stuff. If you only have one will, your poor executor gets the nasty job of having to inventory and appraise the value of all that stuff and pay 1.5% probate out of your estate. And we can avoid that by having two wills. The next thing that qualifies to go into a secondary will is shares of a private corporation. So if anybody on this call tonight has shares of a private corporation, whether it's an operating company or a family business or a holding company, or maybe you have a private corporation that you have rental properties inside of, whatever it might be, it qualifies to go into a secondary will as well, so that all the assets within those private corporations are no longer exposed to a 1.5% probate tax. So it's a no-brainer. If you have a private corporation, you want to have two wills rather than one. The next thing is, if you own any Ontario real estate and you've owned it since before the year 2003, then those assets also qualify to go into a secondary will. So let's say you have a home in Toronto and it's worth $1 million or $2 million, and you've owned it since the year 2000, then that home qualifies to go into a secondary will, provided there's been no change in the title on that property in the intervening years. Now, this is not just restricted to homes. It could be vacant land, it could be a cottage, it could be a farm, it could be a bunch of different things. So if you own any Ontario real estate and you've owned it since before the year 2003, you definitely want to check to see if it qualifies to go into a secondary will, because on every $1 million of value, you're saving $15,000 in probate. Okay, later on in life, let's say that you are a retiree, you've retired, and now you're ready to downsize your matrimonial home because you're an empty nester. And you don't need the big home that you raised your kids in. You're ready to downsize into some kind of a retirement community. There could be a life lease situation where it's not real estate. You have a right to occupy a retirement unit for the rest of your days. Or maybe it's a structure on leased land where you own, like in the community that I live in New Hamburg, Ontario. I own my little bungalow that I live in with my wife, but I don't own the land that it sits on. I lease the land from the landlord. And so that's another kind of structure, that those two types of retirement units can go into a secondary will. And if they're in the secondary will, they're also exempt from 1.5% probate when death occurs. If anybody on the call has loaned money to any of their children or any other family member, or you've invested money in private mortgages. Maybe you've helped your kids out with part of their financing on their home to make it possible for them to buy a house. Those are also assets of your estate that can go into a secondary will and be exempt from probate. If you have any business interests in a partnership, a joint venture, or you have any assets that are inside a trust structure, then those assets also qualify to go into a secondary will and they can be exempt from probate. And Brian, this is new information to you. I've added this since the last time we did this workshop. But if you own any cash, or if you own any precious metals, or if you own any cryptocurrency, and it's not necessary to have a probate certificate to dispose of those assets, they also qualify to go into a secondary will and they can be exempt from probate. So that's what goes into a secondary will. What goes into a primary will, you might ask? Well, in the primary will, those are the assets that the executor requires a probate certificate either to get control of the asset or to dispose of the asset. So the things that are in the secondary will are anything that's not listed, or the things in the primary will, rather, are anything that's not specifically listed as a secondary will asset. So that includes any real estate that you've acquired after the year 2002. It includes bank accounts and any financial assets that you have that are non-registered. If you have any stocks, bonds, mutual funds with or GICs with Brian or with anybody else, any financial institution, it's likely that you're going to require probate before the financial institution is going to be able to hand that asset over to you. With respect to things like RSPs, TFSAs, RIFs, and LIFs, and life insurance, those assets, if you've got a beneficiary designation set up, maybe you've got an RSP or a RIF, and you've got a spouse, and you say, well, when I die, my RSP beneficiary is going to be my wife, but if she's not alive, maybe it's going to be my adult children. So if you have those kinds of structures in place, then when death occurs, if the people that you've named are alive, then they receive those funds outside the will, not through the will, and then they would be exempt from probate. But if the person that you've named is not alive or has never been declared, then by default, those assets are going to fall into the will and they're going to be subject to probate. So in summary, I would recommend that everybody that's on this call should consider upgrading if they've only got one will per spouse or per person to get two wills, because it will save the executor a lot of time and effort. It'll save the estate the cost of probate on certain assets. It'll save the estate the cost of appraisals, and it's much more efficient. The way that a proper will would be designed would be you can't just say, well, I've got one will, now I want to get a second one. It doesn't work like that. It's a complete rewrite of two wills that have to be done collaboratively together by the same lawyer and signed the same day. And they have to properly be drafted to acknowledge the existence of each other. So the primary will acknowledges the existence of a secondary will and vice versa. And the two wills taken together form one estate for tax purposes. The two wills are going to have the same executors and the same beneficiaries. That's not the issue. The issue is that we want to minimize the amount of probate that your estate is exposed to. And the way to do that is by a properly structured primary and secondary will. So having said that, I'm just going to go back up here and show you the assets once again that go in the secondary will. And I'm going to press the pause button for a minute, in a sense, and open up the discussion. Anybody that might have a question related to any of the content that I've covered so far, please open your microphone. If you want to turn on your camera, go ahead and ask your question, and we'll deal with it. So who's got my first question tonight? Okay, Gary, are you asking a question? Sounds like not. Okay, well, don't be shy. The whole point of tonight is to try and have it be a little bit interactive and to allow people to answer or ask and answer questions. And there's no questions that are not good questions. Um, we would like to encourage questions, but if there aren't any, we're going to move on to
Well,
another topic.
I'll throw a question out for you.
Okay,
Uh,
go ahead.
yeah, so let's say you've got a family in Ontario, and let's say their kid is in BC, and they got other kids in Ontario, but the parents are in Ontario. So they got, say, a kid in BC or some other province, and then on top of that, do the same question. Let's just assume somebody's in the U.S. or out of country. So I don't know if you want to address that.
Yeah, okay. Um, so uh, when you have children that do not reside in Ontario, that certainly is something that needs to be discussed as part of the development of your estate plan. Ideally, you would want your executors and your powers of attorney to be residents of Ontario or at least residents of Canada. If they live in British Columbia, it doesn't mean that they can't act as your executor or your power of attorney, but because of geography, it's just more difficult. That's the reality of it. But if your children live in the US or any country other than Canada, in most cases, it's not considered wise to name them to be your executor or power of attorney for property for various reasons. It can be a very awkward thing, and it looks like we've got our first question from Rusi. He's got his hand up. So Rusi, go ahead and ask your question, and we'll take it on.
Yeah, you said household items can be put in the secondary will. Now the
Yes.
question is if I die and my spouse is still alive, these household items are basically jointly owned by us, and nothing's been bought separately.
Yeah. Yeah.
How does one deal with that?
Well, in a situation where we've got a husband and wife, what would happen is there are always three levels of distribution in a will. There's what is the distribution that happens when the first spouse dies. There's what happens when the second spouse dies, and the third one that is not always relevant, but sometimes is what happens if the whole family, including the children, pass away. So in your situation, Rusi, if you pass away first and your will says I leave everything to my spouse, then that's fine. There's no probate that is going to be an issue at that point in time. The probate is going to be an issue when the last spouse passes,
Okay,
or when the whole family passes. So it's a timing thing. It's not that probate isn't an issue; it's when is it an issue, and typically it's going to be when the last spouse passes away.
okay, thank you.
Okay, good. Okay. So just finishing off Brian's question, I'm not going to go into a deep dive on this, but if any of you have children who are in the US, there's lots of issues related to that as it relates to estate planning. But the main one I want you to consider for tonight is those children that live in the US are probably not going to be appropriate people to name to be your executor or your power of attorney for property. They may be able to be your power of attorney for healthcare decisions, but that's it. And you're going to have to find resident people in Ontario that can serve those roles. And if you don't have anybody that you either trust or that you think is appropriate, then the solution is to use a Canadian trust company. Every major Canadian bank has an affiliated Canadian trust company. So, for example, the TD Bank has the Canada Trust Company, RBC has the Royal Trust Company, and I work with all of the trust companies. They know me and I know them, and I have fee schedules for all of them, and I can help you understand what the fees would be if you were to name a trust company. The nice thing about trust companies as executors and powers of attorney for property is they're always going to be a bulletproof solution. When you name your brother, your uncle, your son, your neighbor, anybody like that to be a power of attorney or an executor, it is not a bulletproof solution because it is not a contract and they don't have to do the role. And sometimes when the time comes, even if they said they would do it, if they're going through chemotherapy or a divorce or they've got problems with their children or whatever, it is not a contract, and they can renounce their appointment, and then you need a backup. And in all of the wills and estate plans that I do, I always have a trust company named to be the executor and power of attorney for property of last resort. And why is that? Because a trust company never dies, never becomes senile, is always age appropriate, and never needs chemotherapy. And it doesn't cost you anything to have that trust structure in place. So that means then that if your executor it renounces and they're not willing to do it when you need it to be done, you've given them an escape hatch. You've said, look, if you can't do it when the time comes, don't worry, you can renounce without feeling guilty, because I had the foresight to name a trust company as the last resort, and you didn't have to pay them a retainer. There was no upfront cost. The only thing that you do is you do sign a fee agreement with them while you're alive that says if and when you ever end up acting, I don't think it's ever going to be the case, but if you ever did, then we agree in advance as to what your fees are going to be. And by the way, I don't pay or receive commissions or referral fees to or from anybody, including Brian, including trust companies, including lawyers, including anybody. So that all the advice I'm giving here is without bias in terms of any kind of financial incentive, just so that you know. Okay, so I think I'd like to lead next into a couple of minutes about expanding on the issue of executors. And so being an executor, first of all, is the person in your will that you appoint to be the person that is going to clean up your mess after you're deceased. And being an executor is not an honor you bestow on your children. So the first thing I'd like to tell you is many people, when they talk to me initially about their estate, they say, well, you know, when my wife and I are gone, it's going to be the kids that are going to be the executor. And I'm here to tell you that that may be appropriate, but there are times when it is certainly not appropriate. You certainly do not, in my opinion, want to name your 3 children to be co-executors together, because that means that all 3 of them have to attend every meeting, sign every check, sign every document. None of them can be doing anything related to the estate activities without the knowledge and consent of the others, and it really slows the estate administration down. And it's not really necessary. Frankly, anybody that's acting as an executor is only allowed to do one thing and one thing only, and that is to follow the explicit instructions in the will that you gave them to work with. So some people think, well, I need to have my children do it because they know me and I know them, and so on. And it's not really the right mindset. The right mindset is you should be appointing people to be your executor and your power of attorney for property who have the skill set to be successful in doing the work that's involved. And what that means is they need to be detail oriented. They have to have good common sense. They have to not be overwhelmed with dealing with lawyers and accountants and CRA and realtors and investment advisors and all those people. They have to have a good level of maturity and responsibility, because they're going to be responsible for filing your terminal tax return. And then after that, every year that the estate remains open, they have to file an estate tax return. They have to apply for the Ontario probate certificate. They have to deal with cleaning up any tax issues that remain in your estate. They have to deal with all the beneficiaries of your estate and keep them regularly communicated with in terms of all the ongoing activity. They have to apply to get a clearance certificate from Revenue Canada that all your previous year's tax returns are all complete and Revenue Canada is never going to look at them again. They have to be able to keep an accurate set of financial records accounting for every penny from the date of death until 3 years later when the estate is wound up. So an executor takes a financial snapshot of every asset and every liability that you have on the date of your death, and then they have complete and accurate records as to how were those assets and liabilities dealt with, converted into cash, and then eventually paid out to pay expenses first, and then to pay the beneficiaries later on. And all the beneficiaries of the estate have to sign off at the end of the day that they approve everything that the executor has done. And if we have any residual beneficiary who is unwilling to sign off because of a trust issue or whatever, then it's a very bad thing that's happening, because then the whole estate is going to have to end up going to court, and a judge is going to have to determine what is fair and reasonable. And this includes executor compensation. So every will in Ontario should have declaration of language in it that says, what are you prepared to authorize the executor and the power of attorneys to be paid by the hour to do their role? I think that you should have language in your documents that says, I'm prepared to authorize up to so many dollars an hour. Maybe it's $100 an hour. Maybe it's more than that. Maybe it's less than that. Maybe it's a multiple of the current Ontario minimum wage, but you should declare something so that nobody should then be argumentative about what fair and reasonable compensation would be. You know, the executor presents their time log that shows all the activity of everything they did for the 3-year period they were administering the estate on a day-to-day basis, who they talked to, what they talked about, what they authorized, what they didn't authorize, whether it was a meeting in person or on Zoom or a phone call or an email or whatever it was. So that's very, very important. And then if it's your family members or friends that are doing this role, they have to open up a payroll account with Revenue Canada. They have to issue themselves a T4 slip once their compensation has been approved by the beneficiaries. And then they have to pay tax on the amount of money that they have received as compensation for doing the work you hired them to do. So that's a lot of information in a short period of time. I'm glad this is being recorded so you'll be able to watch this again. But I'm sure that there are some questions about this whole area about picking appropriate executors, both primary and alternates, and then as last resort, a trust company. And sometimes, by the way, some people, when they think about what they want to do here, they may decide that I don't want to name anybody that I love and care about to take on the role of this miserable, rotten, nasty, awful, terrible job. I'd really just rather have a trust company do it professionally as an independent, neutral, third-party professional, especially if we're dealing with blended families where there are children from the first relationship, and now it's a blended family. It's almost always inappropriate to use the children from either side of the family to be the executor. You're almost always going to want to use an independent, neutral, third-party trust company right out of the gate. So those are a lot of things to consider, but let's press the pause button for a minute. And I know Brian has a question to throw in here if nobody asks one, but let's see who else has a question that they'd like to ask. Rusi, go ahead with your question, please.
Hi, Jim. Sometime back, a friend of mine asked me to be the executor for their mother. The father has passed away. I didn't realize what I was getting into, and I neither have the time nor the expertise to be the executor from what I'm hearing. What would you suggest I do?
What I would suggest you do in that circumstance is you advise the mother that, or whoever it is that you've been asked to be the executor for, that it is not your wish to continue to let your name stand. Please make alternate arrangements. And that if no alternate arrangements are made, when that person passes away, you will be renouncing your appointment. And in a well-designed will, there should be a backup so that if you renounce your appointment, there's somebody else or several people, perhaps, that are next in line after you that the baton passes to, and they can then declare whether they're really willing to act or not. But I would say, Rusi, you go back to the person who asked you to be your executor. You say, I'm no longer interested in being involved. Thank you very much. Please make alternate arrangements, and understand that if you don't make alternate arrangements, I will not be acting. And then it's in the other person's court to take it from there.
Okay. Can I ask a follow-up question?
Go ahead.
I mean, they're very close friends of mine. I don't want to can I just tell them that they should add a trust company to the
Yes,
will?
you certainly can. That needs to be done by a lawyer. When you hire a
Okay.
trust company to be involved in your documents, there is very specific language that needs to be added to the will. And
Okay.
normally what happens as well as part of that is there needs to be disclosure to the trust company. So in all of the files that I do, when there's going to be a trust company involved, we always send the estate plan and the legal documents that the lawyer has drafted before the client signs them. We send them to the trust company for their review and make sure that the trust company is comfortable with being what they're being asked to do professionally. Sometimes they will come back with some comments that say, we'd like to clarify this matter or that matter, or this is incorrect, or what about this? And we want to give the opportunity to the trust company to make any final changes that may be involved. So if in this situation it's a close friend and you think that they need to appoint a trust company, then just understand that it's not, it's not a slam dunk kind of a thing. What they really need to do is they need to meet with a trust company, a trust officer, and the trust company, trust officer is going to have lots of questions. They're going to want to be able to see the draft documents that have been redrafted by the lawyer, naming the particular trust company that has been chosen, because it has to be a specific trust company, not just any trust company. And,
Okay.
and the trust company wants to know that the assets support the work. A trust company is not going to be interested in being involved in any estate that's less than $1 million of estate value. So if this is a smaller estate, there are some other options that you can reach out and talk to me about, but a trust company is not one of them.
Okay. Thank you.
And on that point, I just want to mention that I do offer up to 1 free hour of time for anybody that's on this call tonight. If anybody wants to have a triage meeting with me to talk about your own estate or to talk about any other estate that you might have involvement in, then you can reach out to me. My email address is on my website, www.ontarioestateconsulting.ca, and you can reach out to me and I'd be happy to give you an hour of time to triage your situation. Okay, any other questions that anybody has about choosing executors or choosing trust companies or anything like that?
This is Manuel. That's useful information. I just want to know what's the ballpark cost if you want to get, professional trust company. Let's say you have $1 million. So how much are we looking at
Okay,
approximately?
I will be happy to answer that question. I'm glad you asked it. And I'm going to show you on the screen just what that would look like. So thank you for that, Manuel. Okay, so here is a spreadsheet, and this spreadsheet is calculating what the executor fees with a trust company would be on $1 million estate. So the first one that I'm looking at here is Bank of Montreal Trust Company, and every trust company has a similar kind of a structure. On the first $500,000 of assets in the estate, the trust company would be charging 4.5%. On the next 500,000, they charge 4%. So on $1 million estate, the executor fee at Bank of Montreal was the executor would be $42,500, which represents 4.25% of the value of the estate. Now, I know that's a lot of money, but in the context, the province of Ontario says that if Jim Kibble or Brian Poncelet were your executor, and neither one of us is offering because we don't want to be your executor, we would be entitled to compensation of as much as 5% of the whole thing, which would be $50,000. So the good news is a trust company is always going to be less than 5%. In this case, 4.25% if it was Bank of Montreal. If you use Bank of Nova Scotia Trust Company, it would be 4.5%. If you use Canada Trust, which is the TD Bank, it would be 4.25%. If it was CIBC, it would be 4.5%. And so on and so on. A Solus Trust would be the least expensive trust company. They are a smaller trust company headquartered out of British Columbia, but they are licensed in Ontario. Their fee would be 3.5%. And then down below, the Royal Bank would be 3.75%. But once again, if you've named your brother or your uncle, your sister, your nephew, somebody like that to be your executor, they could be entitled to compensation of as much as $50,000. So once again, a trust company is always going to be less cost than using a trust company. Is that visible on the screen?
No.
No, sorry. Let me just quickly refresh. Then somehow that didn't get on the screen. I'd like to show that to you real quick. Okay, how about now? Can you see it now?
Yep.
Okay. So once again, here's the Bank of Montreal. In the first 500,000, it's 4.5%. On the next 500,000, they drop it to 4. So on $1 million, it's 42.5. And then Bank of Nova Scotia trust company would be 45,000. Canada Trust 42.5. So they're all pretty close. And the least expensive would be Solus Trust out of British Columbia. They're 35,000. Whereas an individual executor that's an individual doesn't mean they have to charge 5%, but they could. And if they did, that would be 50,000. So why do you want to hire somebody that's an amateur, that's maybe never administered an estate before, that's probably going to screw it up, and it's going to take longer, and they have personal liability if they cause a problem in the estate and the estate gets sued, they're going to get sued as well. The nice thing about trust companies are they have deep pockets and they know what they're doing and they're not going to screw it up and they're going to do it faster. And if there's ever a lawsuit involved, the trust company has the liability rather than somebody that you care about. So having said that, is that enough of a summary for you?
Mm-hmm.
Yes?
Yes, thank you.
Any other questions related to trust companies or executors? And just before we leave that subject, I will just say the reason that you do not want to have anybody outside of Canada acting as your executor is because the government of Ontario, when it comes time that you die and we need to get probate, the Ontario government is very reluctant to approve an executor outside of Canada unless they are able to put up collateral equal to the value of the estate assets. So if it was a $3 million estate, the non-resident Canadian executor would have to put up $3 million of asset value, and usually that's not something that's easy to do. So they would have to purchase what's known as an estate administration bond from an insurance company, and basically then the insurance company puts up the $3 million of collateral. What the courts are concerned about is that the executor might abscond with the money. They might collapse the Ontario estate, pull it outside of Canada, and leave the Ontario beneficiaries high and dry. So they're very concerned about that. And so that's why they are reluctant to approve anybody as an executor who is not a resident of Ontario, hopefully, or at least a resident of Canada. Okay, one last chance. Anybody got a question about that? Okay, so this is where we're going to open up to you, and I'm going to share my screen once again here. And for the remaining time that we have, I would like to open it up for you to be able to ask, what questions do you want me to address? I'm not going to go into a deep dive on the questions that are related to US stuff, but there are 8 items in the US list. And if you have any US cross-border things happening, my best advice would be book a meeting with me and we'll talk about your situation. But as far as the Canadian stuff goes, maybe I'll make that a little bigger so you can see it a little better. We've already talked about item number 4 and number 5. So is there another item there that somebody would like me to talk about?
Hi, Jim. Did you cover the tax benefit of having a trust versus something else? Sorry, I joined late. So if you spoke about it, it's fine.
Are you talking about putting assets into a trust structure while you're alive?
Uh, y- yeah, and
Or,
that could be done, yes, but
or
it's more like to avoid all the taxation or to make it less once I pass away. So uh
okay,
so so what I'm asking is what's the benefit of a trust versus some other mechanism that might be.
okay.
Yeah.
Well, trusts are created at two different points of time, Emmanuel. Trusts are created either when you're alive, and we call that an inter vivos trust, which means between living people. That's what inter vivos means. Or your will probably or could also have trust provisions that says that when I die, I want certain of my estate residue going into a trust structure for certain beneficiaries. If you had, like Brian does, you have special needs beneficiaries because he has special needs children, we set up trusts so that because they are not able to handle and manage their assets by themselves, they need somebody to do it for them. So their assets are going into a trust structure. It's nothing to do with saving taxes. It's all to do with putting the money into a trust structure because they need that trust structure to have somebody that's competent to be able to manage the assets for their benefit. Or maybe you have children who are minors, or you're leaving money to grandchildren who are minors. Well, you cannot leave money to a child who's a minor under the age of 18. It must go into a trust. And so that's another reason in a will you create a trust structure for that kind of a situation. Trusts are also sometimes created in a will if you have a child who has addiction problems, or they can't manage money, or they are living on the streets, or something like that, or you're estranged from them. There might be various reasons why you might say, I am uncomfortable leaving a whack of money for this particular person, but I do want them to benefit from my will, but I don't want them to have control of the money because I think they might blow it, or they might be unduly influenced, or they don't have a track record of managing money well. I'm going to put it into a trust structure. And there are other times, sometimes we put a trust structure in place when it's a blended family, and one of the spouses says, "I want to look after my spouse, but maybe I don't want to leave all my assets to them entirely. I want to put some of my assets into a trust structure." And my spouse can have the income from those assets, but when I die, I want those assets to go only to my children. So that is all, those examples that I've just given are all trust structures that you create in a will for various specific estate planning purposes. But there are also trusts that you can create during your lifetime that you would transfer certain assets into a trust structure so that they're no longer part of your will any longer, because now your assets are not owned by you any longer, they're owned by a trust. And sometimes the reason people do that is because it can avoid 1.5% probate. Remember, we said in the secondary will, when we talked earlier tonight, one of the assets that qualifies to go into a secondary will is assets that are held in trust. So when you have assets in a trust structure, it's another way that you can avoid 1.5% probate. And in some circumstances, if you establish a family trust and you own a family business, and the shares of your family business are owned by the family trust, there are other fancy things that can happen that will allow sprinkling of income out to your adult children. I don't want to go into that in any more depth than that tonight because it's probably beyond the scope of most of the people on the call. But if any of those things resonate with you and you want to know more about those kinds of things, then I would encourage you to, contact me by email or give me a phone call, and we can have a specific chat about your specific circumstances. Okay, so that's trusts.
Thank you, Jim.
Is there anything else on this laundry list of items that is of interest to anybody on the call tonight?
Probate planning.
I'm sorry, what?
Probate planning, item 16.
Yeah, okay. So we have already talked tonight about the best probate planning tool there is, and that is having two wills rather than one. So I've covered that in quite a bit of depth already, so I'm not going to cover that. There are other ways that people do probate planning that is good. Sometimes it's bad, and sometimes it's ugly. So I'm going to tell you that there are a lot of people that are told by somebody the best way to plan for avoiding probate is to put assets into joint names with your children. And I'm going to tell you that that is almost always a terrible idea. And I would discourage that. This kind of dovetails with, where is it here? Joint ownership of assets, number one on the list. So I'll tell you this, if you're a married couple and you have a house that's in joint names, then the law in Ontario says that when one spouse dies, that house is going to transfer ownership entirely to the surviving spouse. That means that a right of survivorship was intended, and that's great, no problem with that. But if you have a common law relationship, or you are a widow or a widower, and you're thinking about putting your house into joint names with your children to avoid probate, that's almost always a bad idea, because you could, if it's real estate and you're a widow or a widower, your house is a principal residence and it's exempt from no tax on the appreciated value on your house. But if you bring your children into the fold and you name them to be joint owners of your house, you've created a deemed disposition, and now not all your house is exempt from a principal residence treatment. You've screwed it up. So you do not want to do that. And anytime that you put assets, whatever they might be, into joint names with anybody other than a married spouse, you need to have supplementary documentation that declares, number one, whose asset is it really? And number two, when that person dies, is it the intention of that person that the asset is a legitimate gift to the joint owner? Or is it really the intent that when that person dies, that asset is to be treated according to the terms of the will?
Some baby now.
And if somebody intends it to be treated as an estate asset and distributed according to the will, then that asset is subject to probate, regardless of how you've got it registered. So you want to be very careful about this. Another way that you can avoid probate is by using the products that Brian sells. He sells certain insurance products in addition to life insurance that are manufactured by insurance companies called segregated funds and insurance company GICs. And those are other assets that if you own those and you name specific beneficiaries, just like life insurance, those assets are going to pass outside the will rather than through the will when you die, and they would avoid probate. There are some other fancier ways that you can avoid probate using bare trusts and things of that ilk. But for purposes of tonight's discussion, I don't want to go into a deep dive on those. I would say once again, if you have any questions about your specific assets and how to make them exempt from probate in a way that's not bad or ugly, but good, then you should schedule a Zoom with me and we'll customize the talk to relate to your specific circumstance. Any other questions about probate? Maybe I should just sort of backtrack for a moment and just explain what probate is. So probate is a Latin term that means to prove. And the idea is that the executor that you name in your will does not make them your executor. It only nominates them to be your executor. It's part one of a two-part process. So when you name somebody to be your executor in your will, that's great. But then they have to go and they have to apply to the Ontario courts after you die for approval to be the legitimate executor of your estate. And they also do a second approval, and that is that they approve the will that you have submitted to the courts as being the last legitimate will of the deceased taxpayer. And then when the courts do that certification, then and only then does the person have the approval to become the legitimate executor of your estate and to start dealing with your assets. Until the executor has a probate certificate, they have no authority to be dealing with any of the assets in your estate. Your assets are in limbo from the date of your death until the 2, 3, 4, 5, 6 month period later, when probate certificates have been issued by the courts. And it's only at that point that the executor can list the house for sale or deal with disposing of household contents or dealing with disposal of cars or anything like that. An executor cannot deal with the disposal of any assets until they have a probate certificate. And even then, when they do have the probate certificate, they can only dispose of the assets according to the specific instructions that have been laid out in the will, and they must not deviate from those instructions. So that's a lot. Any more questions about anything that we've covered in the last 10 minutes?
Will you have a chance to speak about number 6?
Number 6. Yes, I certainly will. So thank you, Brian, for the question. We're going to talk for a few minutes about family cottages. Now, there have been lots of ink spilled on people writing about what is the best way to deal with the family cottage. And you should consider all that kind of stuff. But I'm going to give you the Jim Kibble School of Estate Planning approach to family cottages, and you don't have to agree with it. And if you don't, that's just fine. But this is the way that I prefer to deal with family cottages. I think that it's almost always a bad idea to have a will that forces your family cottage on your kids or anybody else when you die. I think that if you want to do something while you're alive, to sell your family cottage to somebody, including your kids, that's one thing. But if that's not in the cards and you plan to keep your cottage until you die, then here's the recommended approach. I think at a macro level, you want to decide how are you going to divide your estate among your children. So Brian, I don't know anything about your family, but I'm just going to make all this up, whether it's just hypothetical. Let's say that Brian has 3 children and they all love the cottage. You know, it's where the kids grew up and they've got all their memories there. And it's really, really important. And that's great. And as of 2026, all the kids are really hot to trot. All the kids are... Okay, Sam Andura, can you please mute yourself, please? You're coming through on the call. Okay, so carrying on. So Brian, my advice would be, let's say that you decide that when you pass away, when the last of you and your wife pass away, you're going to leave your estate a third to each of your 3 children. So that's the first decision that you need to make. And maybe you're going to leave some money to charity, and maybe you're going to leave money to other family members. I don't know. But let's just dumb it down and assume that the only people that are going to receive your estate are your 3 children, and they're going to get an equal share. So that's the first decision. It's a third. And then what you want to have is a clause in your will that says that when your estate is being administered, you're going to give your 3 children the right of first opportunity to acquire the cottage from the estate at fair market value, and you're going to give your kids a limited period of time to make up their minds as to which children really want to be involved in ongoing future ownership of the cottage. So let's say you give them a 90-day window, and you say the kids have to come to the table with a legitimate offer to take over the ownership of the cottage within 90 days. And so that leaves the kids to decide at that moment, not today, not based on how they feel in 2026, but how they feel in the year when you died. Because the circumstance could be entirely different. One of the children could be changed jobs and they moved to British Columbia, and it's never going to be practical for them to move the cottage. And one of your children married somebody that hates the cottage and never wants to spend any time there. And another one of your children says, well, I really want to have the cottage, but if I can't have it myself, I don't want to have to share it with any of my siblings. Or maybe two of your children come to the table and they say, we want to take the cottage over as 50-50 joint owners, but we don't want our third sibling involved. So it is possible that when they're wrestling with this, there could be a whole lot of moving parts to this. Or maybe one of your children now has a disabled child and your cottage is not mobility friendly and it's just impractical for them to use the cottage. So, or maybe you've got one of your children that can't really afford their 1/3 share of the expenses. So there's all kinds of moving parts, and I suggest you don't try and sort that out now. Sort it out when it comes time to administer the estate. Let the kids sort it out. And we would put a clause in the will that says the executor has to get a legitimate fair market value assessment as to what the value of the cottage is at the time. And whoever wants to put together an offer to retain the cottage can acquire it at fair market value before the executor has the authority to sell it on the open market. So the kids get first kick at the cat, and they don't have to compete in the open market if they want the cottage. But if they can't within 90 days come with a viable ownership structure, then after that, that offer lapses and the executor has authority to sell the cottage on the open market. If there's more than one offer that comes in, the child that says, I want the cottage, but only if I can have it without any of my siblings as partners. And the other two kids say, well, we want the cottage too, but only if we don't have to share it with the third child. That's fine. What happens then is the offers come to the executor in a sealed envelope, and whichever offer is higher that meets or exceeds the fair market value of the cottage, that's the offer that the executor is authorized to accept. And if the children want to use their 1/3 inheritance towards the purchase price of the cottage, that's fine and dandy. They can do that. But if their 1/3 of the purchase price is not going to cover fair market value of the cottage at the time, then they have to finance the difference. So if their inheritance is 500,000, but the cottage is worth 750,000, and the cottage is only the only offer that comes in is from one of the children, that's fine. They can the executor will transfer the cottage ownership to that child, but they have to, in addition to their 500,000 of inheritance, they have to come up with financing out of either a mortgage or their own resources to come up with the additional 250,000 to close that transaction. I really think that works. It's not the only way to do it, and not everybody would agree with me, but I've worked on over 800 estates, and lots of them involve this kind of a situation. And I think that this situation is time and again proven to be a very viable way to do it. And it's fair to all the children, and let the children make the decision as to who's really vested in wanting to continue the ownership of the cottage. Maybe by that point in time, they've decided that, no, we're just going to sell the cottage. And any of the children that wants to put an offer on the cottage can do so. But maybe the children have decided at that point, we really just want to acquire our own cottage, or we want to use the money. We don't want our inheritance tied up in this cottage because we want to put an addition on our house, or we want to put our kids through university, or we want to, travel, or whatever it is that they want to do. They don't want to have their money tied up in a cottage property. You can't force them to do that. So, Brian, that was a lot. Do you have any follow-up questions on anything I had to say?
No, I'm fine with that.
Okay. Okay. Anybody else have any question about cottages? I would say that another thing that's a parallel topic is if you have shares of a private family business. Sometimes this approach works well there also, where you say, when I die, when the last spouse dies, the shares are going to be offered to the children, and the children can figure out who really is vested and wants to be involved in ownership of the family business going forward. There could be multiple offers if they don't want to be partners together, blah, blah, blah. It's a very parallel kind of thought process, and it works well also. If you don't come to some kind of a deal with your kids to sell them the family business while you're alive, and it's going to be dealt with in the estate, then I think all these ideas are parallel and can also be applied to that scenario. Okay, is there any other topic here that's on the list that anybody else would like me to address? I'm prepared to go. We've been at it for an hour. I don't want you to keep me more than you want, but I'm prepared to go as long as another half an hour if there are other topics that people want to hear about. But if not, then we will wrap it up. But is there anything else on the list that anybody would like me to address?
Does the same thing apply to condos if you own a condo instead of a cottage?
Yes, absolutely. Or a matrimonial home. Let's say that Manuel, let's say that you have a condo that you and your wife live in, and you want to give a right of first opportunity to your children to say, I don't want the condo being sold on the open market by the executor without giving my children the right of first opportunity to acquire it, but they have to acquire it at fair market value. So you could have a right of first opportunity clause in your will that says you're giving the kids 90 days or whatever the period is that you feel comfortable with to make up their mind as to whether any of the children want to take over the condo from the estate at fair market value. And the same thing holds true for rental properties. If any of you have rental properties in your investments, you might want to have a right of first opportunity that says, I want to make it possible for the children to retain any of the rental properties that I own, but do not force the rental property ownership upon your children. I think that's really bad estate planning. Give them the right of first opportunity to retain any rental properties that they want to keep using their inheritance and possibly supplementary financing, but do not force any assets upon any of your children is the general principle I want to drive home. Okay, any other questions anybody might have? Rusi, go ahead with your question, please.
Yeah, the question I wanted to ask is, can you get out of being an executor before or after the death of that person? Or are you forced once you have agreed?
I'll just reinforce what I said earlier. Being an executor, if you are an individual, is not a contract, and nobody is obligated to be an executor. Even if you said, I would be willing to let my name stand to be the executor, does not mean that you have to do it when the time comes. And if you've been asked to be an executor, you may not even know about it. Somebody may, in their will, when they're doing their estate planning, they may name you to be the executor of their will, and they might never even ask you if you would be willing. So there's no law that says that you have to serve as anybody's executor. And if you don't want to, you renounce your appointment. But what you must be very careful about doing is doing it in writing, and make sure that you do it immediately after you find out that you're being asked to be the executor. What you must not do is start acting as an executor for a week or a month or a couple of months and then decide you're in way over your head. It's way more work than you ever knew about, and you want to resign at that point. Now it's not so easy to do because you have to get released by the courts. So never start acting as somebody's executor if you don't want to be the executor for the long run. Renounce immediately, say thanks but no thanks, I'm out of here, and never start taking on any of the roles of any executor. And be very careful about, like, I don't know why anybody would want to be an executor. I think a trust company is such a better idea, using an independent, neutral, third-party trust company. If you use your children to be your executor and something goes wrong, now you've got your children being mad at each other and finger pointing and trust issues and all the rest of it. If your kids are going to get mad about how an estate is being administered, it's way better to let them get mad at a trust company rather than their sibling. Okay, so that's just, we've covered that before, but there's a little bit more information about that.
Thank you. Thank you.
Okay, I'm gonna pick the next one. If nobody's gonna speak up, I'm
Hi,
gonna
Jim,
talk.
Can I pop in? Can I ask a
Go
question?
ahead. Yeah.
I know you touched a bit on number one, which is the pitfall of joint ownership of assets. Are you able to expand on that? I know you touched it based on one of the other questions, on one of the other points that you had. Are you able to expand on that? I know you talked about especially with the primary residence of a parent, the joint ownership.
Okay. Well, you give me a hypothetical example, and I'll tell you what I think about it.
So I'll actually tell you. So a parent has put her only child, their only child, it's a widowed parent, their only child and their spouse on the primary residence where they live in. The children live in their own property for investment purposes, so they can borrow on it to invest.
Okay. So that's a risky thing for the widow or the widower to do, because I think that it's very wise that when you own a home, you're in control of it for as long as you live. If you have people on as joint owners of your real estate, uh, they have the right to put a mortgage on the property, to strip equity out of your property. You've screwed up the principal residence exemption, so that house used to be a principal residence, so it was exempt from capital gain, any kind of a capital gain, but now it's exposed to a capital gain. What happens if that couple that the child and their spouse separate or divorce? Now you've got a real mess in terms of family law. Um, there are a whole bunch of reasons why that should not be done. If I was doing that, what I would have done is this: I would have left the home in the ownership of the widow. If the widow wants to take out a mortgage, then let them take out a mortgage. And then if they want to lend that money to their son or their daughter and their spouse, do that by way of a secured promissory note, so that the son and the daughter can do investing. That's fine under whatever the terms are. But I would not ever, ever, ever put the children and their spouse on title to the home that's owned by the widow or the widower. If the objective was to make equity available for investment, there are lots better ways to do it rather than putting the kids on title.
I think the reason for that was the widower could not qualify for a mortgage on their own, and the children could get better financing or more financing.
Well, then the way that can be handled is that the children can go on title for just 1% of the value of the home. And 99% of the home can continue to be owned by the widower who doesn't have the qualification. Or the widower, the widower can stay on title for 100% of the asset, but the daughter and the son-in-law can co-sign on the mortgage. There are lots of other creative ways to deal with getting the financing for investment purposes without doing what was done here.
Would the principal resident exemption still apply? I'm sorry, primary resident exemption still apply if it's 1% and 99% ownership structure?
It would for the 99%.
Got it. Okay.
Because it would be, I think the way it would be worded. Now, remember, I'm only a lowly chartered accountant with an estate planning designation internationally and in Canada, but this is more of a real estate law question. And I think you really need to discuss this with a good real estate lawyer. But I think what would normally happen is it would be tenants in common, not joint tenants. And maybe the son or the daughter and the son-in-law would be on for 1% of the value as a tenant in common, and the other 99% would be retained by the parent, and that way the principal residence exemption would continue to apply for 99%.
Perfect. Thanks, Jim. Appreciate it.
Okay.
Jim, just a question to clarify what you touched on before. You mentioned something about gifting if it's a joint ownership between you and your wife. if the principal residence is, and one of the spouses passes away, does it not automatically, or does it not automatically transfer to the surviving spouse, or do you need to actually have a will that says that you're gifting it, once you die, you're gifting it to the other spouse?
No, if we're talking about a married couple, we're
Yes.
not talking about a common law couple. Common law is entirely different.
Mhm.
In a common law relationship, the common law spouse has no rights to anything unless there's a will that says differently. But when
Okay.
you're married and you own real estate together, then if the husband dies and the wife is a surviving spouse, then the ownership would revert 100% to the surviving spouse. They still have to do something called a survivorship application to take the husband's name off of title, but it would happen outside the will, not through the will. However, if the husband and the wife were in a car accident together and they both died, then the house is going to flow through the will and it's going to be distributed according to the will. So you need a will as well, but the house is only going to flow through the will when the last spouse dies, not when the first spouse dies.
Right. Got it. Thanks.
Okay. Any other questions? I would like to touch on one. I was just going to do it quickly. Item number 8, I think, is a helpful one to know about. And this is where, parents want to help out their children financially as the years go by. And sometimes they want to help out one child more than another. Maybe you've got one child that's really doing well in life and is financially okay, but you've got one that's not so okay. And so the preferred approach in the Jim Kibble School of Estate Planning is do not give any money to any of your children, but be generous with your children by way of loans. So if you have children and they need some help, financing the purchase of a car or a house or starting a business or, putting kids through university or anything like that, I'm not opposed to that. I think that's part of the deal when you're a parent. If you have the finances available, then help your kids. But what I think the right way to do it is loan the money to your children and get them to sign a promissory note. So I'm going to pick on Brian and his hypothetical 3 children again. So let's say that Brian has 3 children, and for various reasons, he's loaned money to all of them during their life. And by the time he and his wife die, there's been $100,000 that's been loaned to one child, and $50,000 to another child, and only $5,000 to the third child. So by having what's called a hodgepodge clause in your will, a hodgepodge clause says that any promissory notes that are outstanding when the last spouse dies are going to be automatically forgiven. They never have to be repaid, but those loans are going to be deducted from the child's inheritance so they don't get the double dip. So the child that had $100,000 of loans advanced to them during their lifetime gets a third of the estate less $100,000. And then the second child gets a third of the estate less $50,000. And the third child gets a third of the estate less $5,000 so that it automatically equalizes. And if you are lending any money to your children when they are married or they're in a common law relationship, you want to make sure that you get both of those children and their spouse or their partner to sign the promissory note so that when you advance money to them, if their relationship goes south, the partner or the spouse cannot walk away from the obligation to repay you. So that is the Jim Kibble School of how you want to help your children. Do it by way of promissory note. It can be an interest-free loan. It can be on demand. And maybe, you tell them it's never my intention to have you need to repay this unless I run out of money when I'm old and decrepit and I have to call some of this loan back to help pay for my long-term care. That's a possibility. But if you're well off and you don't think that's ever going to happen, that's fine. But I really think that doing financial support to your children, it can be to your grandchildren as well. You can do the same thing with them. I think that really works well. And then you can deal with it in your estate plan as to how you equalize it when you die. Anybody got any questions about that idea?
What if you just gift the money? You said never gift it. Can you not just give them money?
Absolutely, you can do whatever you want with your assets while you're alive. And if you decide that you want to gift money to your child, or to pay for their wedding, or to help them with a down payment on a house, or they have medical needs, whatever it is, if you want to do that, go ahead and do that. I'm not against that, but just understand that that money is gone, and the problem is if you end up gifting money in a different amount to one child than another child, you have to think about how, is that going to be a concern when it comes time to deal with your estate settlement. And if one child has received a whole lot more than another, if you've got it isolated by way of promissory note, it's automatically looked after in your estate plan. But if that's not the case, then every time you gift money, if you want to equalize it, you have to go and amend your will, and that costs legal fees to do that. So all I'm trying to suggest is an efficient way to deal with it in your will that's once and done rather than piecemeal, unless you don't care. If you want to give 50,000 to one child and or 50,000 to all your children and they've all received equal benefit, then it's kind of a red herring. It doesn't matter. But sometimes in life it doesn't work out that way.
Yeah, thanks, Jim.
Okay. We haven't talked at all about power of attorney for property. We haven't talked about guardians for minor children. We haven't talked about charitable giving, beneficiary designations. There's lots more that we could talk about, but I think, Brian, have you been monitoring the chat? Is there anything in the chat anybody had a question in the chat that we need to perhaps consider?
What I've mentioned to a few people is, if they've got any questions, they can reach out to yourself. And as mentioned before, this is recorded. So if you reach out to me, send me an email, say, hey, Brian, I want this. We can certainly deal with that. One thing I should mention, because I've had my will done 4 times, and so I'm going to speak from experience and as a father. What Jim does, and he does a great job on what I call like a mind map. So he'll spend a fair bit of, depends on how complex your estate is, but I'm generally in stereotype, and Jim, you can tell me if I'm wrong, but a lawyer is going to spend maybe 2, maybe 3 hours. They're not going to spend, half a dozen, 10 hours, for many, many situations. Sometimes they will, but the majority of people, they won't. And so what I see Jim as, and Jim, you tell me if this is correct, Jim is really sort of like the quarterback. He's going to sort of lay out all the pieces, put it all together, take a bit of time to think about, ask some very important questions. What do you want, etc. And then once he gets that whole mind map going, and especially if you've got kids from different marriages, or you've got everybody's a little bit different and unique, then puts all that together and gets the lawyer to ultimately sign off and stamp that off. But I can't emphasize. I mean, I'm going to suggest most people who are on this webinar, you've got estates. I'm going to say, bare minimum of 2 million, 3 million, and more. So you got to ask yourself, okay, how much money should I spend to get a will done that's proper? And the answer is, yeah, you should spend a few bucks. Because I always see people who trying to cheap out. I got a will done about a year ago, and it's clearly not done properly. Well, if it's not done properly, should you fix it now, or have a problem later? Now, as Jim mentioned, having a will is better than no will, but can we improve it? I'm going to suggest virtually everybody here. We can certainly improve on what you have, and then to take up Jim on his offer, if you pick his brain or use his time and sort of have a list of questions you want to ask Jim, you can say, hey, am I in good shape or not? Maybe you can tweak it. So that's what I would suggest.
Brian, do you mind if I just cover my pricing model before we wrap up?
Yeah, sure. Absolutely. Go ahead.
Okay. So in case anybody is out there and you've heard enough tonight that you kind of want to know what the pricing model looks like, I'll just go through it with you here. Just getting myself organized here for a second. Okay. So depending on whether you're an individual, you would be in the blue column, or if you're a couple, you're in the red column. And I'm happy to give anybody that wants it 1 free hour of my time on Zoom for a triage meeting, and no cost for that. And then you can decide from there what you want to do. If you decide to hire Jim Kibble to be your quarterback for your estate planning upgrade, as a chartered accountant, I bill my time out at $250 an hour plus HST. And if I was dealing with a simple situation, it would be about 5 hours of billable time to do everything that I would do to develop the estate plan, educate you, gather your data, and distill it into the mind map that Brian talked about and a spreadsheet. Those two documents combined are the comprehensive estate plan. And when I talk about simple, here's what I mean. It's mom and dad, a cat and a dog, a couple of kids in a first marriage, and nothing more complicated than that. If you've got special needs children and blended families and property in Florida and a corporation and a cottage and all that kind of stuff, it is all stuff that adds extra time. So after I have a triage meeting, I can probably give you some idea as to what the cost might be, but the simple situation would be 5 hours. Okay, somebody mute themselves, please. Okay, so 5 hours of Jim Kibble's time is $1,250. And then when we send your file off to a lawyer for a quote, I don't control what a lawyer charges. So if it was a couple, depending on the complexity of the estate plan, if it was a simple situation, it would probably come in between $1,600 and $2,500. So middle of the road, $2,100. So my fee plus lawyer's fees plus taxes would be a little, in and around $3,000.
Okay, I will give it a call.
And then that would be for 5 legal documents.
Bye.
That would be a primary will and a secondary will that we've talked about tonight, the power of attorney for property and personal care, and an affidavit of execution. So if you're a couple, there's 10 legal documents that you get from the lawyer. And if you're not happy with the price that comes back from the lawyer, that's fine. We would just go to another lawyer and get a quote from them. I typically work with lawyers that are in the Kitchener-Waterloo area, which is close to where I live. But those lawyers deal with anybody anywhere in Ontario, and their rates are typically about half of what the equivalent lawyer would cost in the GTA. So there's quite a bit of cost savings. And the lawyers that I use, I have vetted. I've seen the quality of their work. I know they know what they're doing. They are collegial. They're collaborative. They're sharp. They don't have big egos that get in the way and cause problems. And they can turn the work around for a fair price, but not more than a fair price and in a reasonable period of time. So I'll leave it at that. That is kind of my sales pitch. But in closing tonight, if you're a basic person, it's not going to be less than $3,000 to do the estate planning. And most of my clients are going to be somewhere between $3,000 and $5,000 because almost nobody has that simple situation that I described. There's almost always something that's more than that. But I will tell you that by going through it, almost always you're going to recover the cost of your estate planning in terms of probate savings in your estate that you're going to achieve. So, Brian, that's that.
Yeah, I was just going to add in for people who are my clients, I chip in or will cover a half of Jim's time up to 10 hours. So if you're a client of mine, I'll cover half of that out of my own pocket. Okay. And I always got guys who are with advisors, and I always say, well, somebody's charging you some fees, so maybe get the other advisor to cough up some money.
Yep.
So
this is my website once again, just as we're closing here, ontarioestateconsulting.ca. So if you need to reach me for some reason, or you want to, go through Brian, that works too. And I'd be happy to give anybody an hour to have a chat. And Brian, kudos to you for being a proactive advisor and putting these workshops together. I think you add a lot of value in what you do. and not every advisor does. And I'm confident that everybody that was on this call tonight is going to get something that's of value to their estate planning. So my hat goes off to you.
All right.
Okay, we'll wrap it up then. And thanks everybody for being on the call tonight.
All right.
Good night.
Take care. Bye.
Good night. Thank you.
Bye.
Bye.